In the margin expansion, I think you mentioned productivity initiatives. How much more productive can they be? What are the sources of that productivity?
At a restaurant level, they're spending a lot of money on tech investments. A large percentage of their CapEx is being, or a small percentage of their CapEx is being spent on tech implementations. That's planned to give a digital roadmap. They're trying to offer iPad ordering options instead of using a waiter. They're just trying to make the restaurant a lot more efficient, make it a quicker experience for the customer, which is matching that trend. Now, how is that going to help their bottom line? It's going to increase traffic throughput. That's what people care about in this industry. That's going to allow more customers to come in on a daily basis, and hopefully that will help to improve margins.
Additionally, the company is implementing a few technology initiatives, which one of them is actual versus theoretical costing. So they're using the actual cost of their inputs rather than a weighted average, and that helps them kind of optimize their margins as well. And additionally, they're using labor optimization technology, which allows them to minimize the amount of people they have on staff at any given time.
Can you explain a little bit about the comms for Q4, or is there any seasonality in the customer traffic?
Sure, that was a question that a lot of the equity research analysts brought up on the company's last call. There is some seasonality in the business. Typically, the earlier quarters, quarter one and quarter four tend to be the best, with the quarters in the middle not as well. And when we talked to when the company had their Q4 call, they didn't specify exactly how the company had performed or how they had been performing thus far in the first quarter. However, the company had beaten pretty much every single peer in the fourth quarter of 2014, and did hint at the fact that they were well above their consensus for the first quarter of 2015.
The company has outperformed peer same-store sales growth over the past year consistently. The company actually doesn't break down same-store sales growth for emerging markets versus domestic same-store sales. So we believe this outperformance is largely driven by the Brazilian stores and other stores abroad.
You made the statement twice that you get something that the street doesn't. Once for the debt, once for they don't appreciate the emerging market opportunity. Can you give some more substance to that claim?
Sure. So when researching the company, we were looking at a lot of the sell-side models to see how research analysts were projecting the company going forward. We are also researching some of the debt. Now, the company is fairly levered. This is a lot of leftover debt from Bain's buyout. They refinanced both of their term loans last year, and when they refinance those term loans, one of the covenants specifies that they have to pay down 50% of their excess cash flow, as defined as operating cash flows.
I'm sorry, how did you discover it when nobody else has figured it out?
Well, I mean, when we're looking in the models, the covenants specify they have to pay out half their cash flow, and none of the sell-side models were actually showing any sort of prepayment on that debt.
It's in an 8K that the company filed in June, like hidden deep inside of it. Whenever management talks about their target debt to EBITDA ratio of 2.5 times, they never mention explicitly that it's required by their covenants.
Okay, thank you.
What happens if they miss that?
Excuse me,
if they fail to meet that covenant, how draconian are the penalties?
Well, I mean, they'd be in default of the loan, but they're nowhere near that risk. This is why it's not even on our risk slide. The company's fairly levered, but they have so much excess cash flow that it's not a problem. Not to mention, if they don't have, I mean, even if the company doesn't have, they just have to pay out 50% of their excess cash flow. If they don't have the cash flow, they don't have to amortize the debt.
And how much of the revenue comes from Brazil, and how many stores do they have in Brazil versus, say, outside of Brazil?
Sure. Well, the company has 227 international locations and roughly 1,250 domestic locations. So the Brazilian locations are roughly 60% more on the top line. So just doing that math, it's roughly 15% is coming from international.
There's a clear trend in this country about eating a little bit more healthy and being willing to pay for it. The biggest contributor here is red meat. What's your thought on the risks that come from a trend towards healthy eating?
Sure. Well, actually, we're very confident in the way that management has sort of adjusted their individual concepts for the risks and trends in those markets. So an example I'll use to that is exactly the heavy Italian food, which is one of the problems that they were facing with Carrabba's recently. So they've actually recently launched a new, lighter and less expensive menu in order to address that trend.
To kind of go further on your point, organic is being more and more popular. That's a little bit more expensive. So the main trend we really want to address going forward is how can they pass those increased costs on to customers, and how are those customers going to react? So that's something we would really want to address.
You had I think you made the point that you thought that the real would return to some sort of mean. If we're in a prolonged commodity slump, what does that do to the sensitivity of your valuation?
Specifically, as far as commodities affecting the company's operations, we believe Brazil acts as kind of a natural hedge as they're a commodity-driven environment. So whenever the price of oil goes down, consumers in the United States do better, so the restaurants here are doing better. The Brazilian restaurants are getting hurt, and it kind of acts as a natural hedge. As far as the currency goes, even if the real does stay weak against the dollar for a prolonged period of time, this is largely mitigated because they're not going to repatriate cash for the foreseeable future. So there may be losses, but it's on paper.
For the cash flow recapture on the financing, is the debt, this was the debt that was put in place in 2012,
This debt was refinanced in 2014,
2014?
but it
It's
was
still-
the buyout debt from 2006.
Okay, so it has that cash flow recapture, which seems high based on the current market. Is there any likelihood that they could refinance that debt without that restrictive covenant?
Well, actually, that's a very good question. The company, about 2 weeks ago, refinanced its second term loan with its revolver, which actually paid 75 basis points of less interest expense. So that's one way that they have reacted to that in order to sort of get out of having to prepay so much debt.
Okay. In a rising interest rate environment, what is the mix of fixed to floating rate debt for the company at this point?
Okay, well, their term loan is the only remaining fixed interest rate piece of debt right now. Everything else is currently floating.
Okay. In regards to food cost, beef did you look at the kind of trends in commodity cost, particularly for beef, and how that might affect the company's earnings in regards to cost of goods sold?
So the cost of beef has come up over the past couple of years. Year to date, it's actually down a good bit. And we believe this is a positive for the company because on the way up with rising beef costs, they're largely able to pass this along to the consumer. However, on the way down, if the inputs decrease, they're largely able to keep the prices up, so it actually helps margins a little bit.
Okay. In regards to the $50 million a year in regards to productivity savings, did you make a judgment as to how achievable management's forecast for that is?
Sure, that's another very good question. This has actually been a goal of theirs since 2012, and they've exceeded this goal every single year since then with those productivity initiatives actually cutting costs between $75 million and $65 million a year.
In terms of, the company, you said that the company is focusing more on remodeling instead of buying restaurants now, buying location.
Yeah, so that's...
So what is the, how much is the cost saving from that?
So remodeling doesn't necessarily save them cost. Mm-hmm. It's more of the increase in sales. They're seeing like 20%, and when 20 to 40% sales increase, that's really what they're targeting. And then moreover, it's a result of them trying to avoid the high cost of buying grade A real estate in the U.S. because there's so much competition here. The CDR per capita is the highest in the world here, so that's really their main focus in the remodeling.
Additionally, the remodeling typically costs about $1 million to remodel a location, and it has a payback period of about 3 years.
The restaurant space is a fairly active area for acquisitions. Did you look at the possibility of another either private equity buyout scenario and how transaction comps would model against their current valuation?
Sure. We would assume in a buyout environment we would expect roughly a 20% premium to what the company currently trades at. That's typically what we've seen, at least in the past. The company really recently just sold off some of their assets. They used to hold another concept called Roy's, which they sold. That deal was closed last year.
So you made a statement that Real is selling low, but you think it's going to go back. Is that a prediction? And also you said these are paper losses. Are paper losses not real?
Good question. We do not make a prediction on the real. We're just saying in case if it does not appreciate against the dollar, the company is not going to take any hits. Their assets and liabilities in Brazil are largely matched, so they're not actually injecting cash into Brazil or taking cash out.
Thank you.